Starting to invest can be one of the most confusing parts about personal finance, with so many conflicting opinions and advice out there. But instead of rigid rules, I'll share my 5-step framework that works for anyone. Saving versus investing. First, let's meet low growth Larry and steady investor Sally to see the power of smart investing versus only saving. Low growth Larry earns a lot of money and saves $20,000 a year in a TD savings account, earning 0.01% interest. Yes, that is their current rate right now in these accounts. Over 30 years, Larry contributes a total of $600,000 but ends up with just $600,931. His money barely grows and it actually loses the real value of the money due to inflation. Steady investor Sally, meanwhile, invests $7,000 a year in a portfolio and earns an annualized 7% return. Over the same 30 years, she contributes a total of just $210,000, but her investments grow to $707,000, outpacing Larry by over $100,000, even though she contributed far less. Think of your investments like a snowball rolling downhill. It starts small, but grows larger as it collects more snow, like compounding returns along the way. Here's step 1 of the framework, which is developing your investment philosophy. Start with the why. This is the most important step in your investment journey. Too often, people dive into investing simply because they feel like it's something that they should be doing. But investing without purpose is like setting sail without a destination or a compass. You'll end up drifting aimlessly. Instead, have a clear purpose. Why do you want to invest? Is it to save for a down payment on a house, retire comfortably, achieve financial freedom, fund your education, provide for your family? The more specific and personal your reasons, the stronger your foundation will be. For me personally, my purpose for investing is all about freedom. The freedom to live life on my terms and the confidence that comes with financial security. I've been fortunate enough to build my investments to a point where money isn't a constant worry anymore, and it's made a world of difference in my personal life. It's allowed me to take calculated risks both in business and personal pursuits, and knowing my finances are in order gives me the clarity and motivation to stay consistent with my strategy, even when it requires delaying gratification for bigger rewards down the road. When you know your why, you'll find it easier to stick to your plan, weather market ups and downs, and make decisions aligned with your long-term goals. So take a moment to reflect and get crystal clear on your purpose. It's the key to building a strategy that lasts. Step 2, figure out how much you can contribute. Once you've nailed down your why, the next step is determining how much you can contribute towards your investments. This is where having a clear contribution strategy comes into play. Start by reviewing your budget. How much can you realistically set aside each month for investing? If you don't have a budget yet, now is the time to create one. Track your income and expenses to identify opportunities for saving. Even small adjustments like cutting back on subscriptions you don't use can free up extra cash for your investments. It's also helpful to automate your contributions. Set up recurring transfers to your investment accounts on payday so investing becomes a habit, not a decision you have to make every month. Remember, contributions are the lifeblood of growing your portfolio. The more you invest consistently, the more you'll benefit from compounding growth. And here's the impact of different monthly contributions over 30 years. This table highlights the power of consistent investing at a 7% rate of return over 30 years. Even just $100 a month grows to over $121,000 over this time period, showing how small consistent efforts add up. Increasing to $500 per month builds a portfolio worth more than $600,000, enough to make a significant difference in retirement planning. And if you can get to a consistent $1,000 a month, this can grow into over $1.2 million, which gets you very close to financial freedom. I dive deeper into this in a video about how important contributions are to building a massive TFSA. Check it out here. It's packed with tips and examples to help you maximize your contributions and stay on track. Step 3 is to choose your investments. This is where things can get tricky. Choosing your investments is the most time-consuming and confusing part of the process of investing for most people. But it's also where your investment journey starts to take shape. Spend the most time here doing your research. You must first understand your risk tolerance and time horizon. Before picking investments, take a step back and assess how much risk you're comfortable taking. Are you okay with seeing your portfolio dip during market downturns, or would that keep you up at night if it's anything more than, say, 10%? Your time horizon, how long you plan to stay invested, also plays a major role. Longer timelines typically allow for higher risk investments because you have more time to recover from market fluctuations. If you're not sure where to start, tools like Vanguard's free investor questionnaire can help. It's an easy way to figure out your risk tolerance and investment style by answering a few simple questions about your goals, financial situation, and comfort with risk. The true test of your risk tolerance, though, will be your actions when the markets are crashing. As famed investor Peter Lynch once said, everybody in the world is a long-term investor until the markets start going down. And what he meant by this is that most people think they could tolerate a lot more risk that they can actually handle in reality. Where to start for beginners? ETFs and robo-advisors, these are great for beginners because they're diversified and require little management or time from your end. You can look at things like all-in-one ETFs such as VGRO or robo-advisors such as Quest Wealth. Individual stocks, once your confidence grows, you can explore stocks, but stick to companies you believe in and understand, and also try to diversify. Advanced options. As you gain experience, consider diversifying into things like real estate, private equity, or even hiring portfolio managers, which is something I've had a lot of success with in recent years. Here's a list of the pros and cons of some investment options you can consider. Pause it here if you want to take note of each of these options. And here are two big mistakes to avoid, which are avoiding panic selling. This chart from JP Morgan highlights the importance of staying invested during market downturns. A $10,000 investment in the S&P 500 from 2004 to 2024 grew at an annualized rate of 10.5% if fully invested. And that was even through the financial crisis in 2008. However, missing just the 10 best days reduced returns to 6.2%, and missing the 30 best days dropped them to 1.4%. Panic selling often means missing key recovery days, and staying invested is critical for long-term growth. The next big mistake I see is staying on the sidelines. Waiting for the perfect time to invest is a losing game. Even investing at the worst possible time often outperforms just sitting in cash. Start with the basics, learn as you go, and don't overthink it. Step 4 of this framework is to choose your accounts. Choosing the right investment account can greatly impact your after-tax return. In Canada, the TFSA, RSP, FHSA offer unique tax benefits. Here's a comparison of $10,000 invested over 30 years at 6% growth, using these assumptions of a current tax rate of 40%, a future tax rate of 20% when you withdraw your RSP, and a non-registered annual growth is taxed at 40%. We're also going to assume a time horizon of 30 years here. As you can see, the RSP comes out ahead with an after-tax balance of $64,327, thanks to the upfront tax refund and tax-deferred growth. However, this works best if your retirement tax rate, in this case is 20%, is quite a bit lower than your current rate, which is 40%. The TFSA is a close second, growing to $57,434 entirely tax-free, making it ideal for flexibility and withdrawals without tax implications. The non-registered account, it only grows to $28,893, showing how annual taxation drastically limits your compounding growth. That's less than half your take-home RSP in this example. For more details on the best account order of investing in Canada, check out my other video on this topic. I do a deep dive into this. Step 5 is to buy the investments and then track the performance. Once you've chosen your investment accounts and your strategies and what you want to invest in, it's time to actually go out and buy your investments. I'll focus mainly on how to actually buy the stocks and ETFs here. How to buy stocks and ETFs. First, you have to pick a platform. I really like Wealthsimple, which is a user-friendly platform, great for beginners. It offers commission-free trading for stocks and ETFs, making it affordable to start. And there's also Questrade, which is ideal for a little more active investors or those looking for advanced features. It has low trading fees and ETF purchases are free. Then you need to set up your account. So you have to choose the type of account you want to open, like a TFSA, RSP, FHSA, or a non-registered account, and then provide your personal details, verify your identity. Then you proceed to funding your account. There's a couple ways you could do this. You could transfer money from an existing account in kind into your new investment account. This can take several weeks. You can also just transfer in like cash from your savings account, which could take a couple business days depending on the bank and the platform. Then you have to place your order. For things like ETFs, you search for the ticker symbol, for example, a VFV for the Vanguard S&P 500 ETF. Decide how many shares you want, review the cost, and place a market or limit order. For stocks, it's very much the same process as the ETF. You just find the ticker and purchase it. Then monitoring your investments. Analyze the performance. Keeping an eye on your portfolio is important to make sure you're on the right track. Compare your returns to benchmarks like the S&P 500 to see how your investments stack up. If one part of your portfolio, like say an individual stock, has grown way more than others, it might be time to rebalance to keep things more aligned with your goals and to reduce risk. Also, don't forget to check for sneaky fees or taxes. They can quietly chip away at your returns if you're not paying attention. Track your net worth. Tracking your net worth is a great way to see how you're doing overall. It's simple, just add up everything you own, like your investments, savings, and property, and subtract what you owe, like loans or credit card debt. Watching this number grow over time is super motivating and gives you a big picture view of your finances. I built a free net worth tracker that you could use. Download it on my website to make things easier for you. Be consistent. The key is consistency. Whether you check your investments monthly, quarterly, or even just once a year, pick a schedule that works for you and stick to it. Monthly is great if you like to really stay on top of things. Quarterly works if your portfolio is more stable. And if you prefer the passive, long-term investing, annual tracking is more than fine. Always remember to learn from your mistakes. We all mess up sometimes. It's part of investing. Maybe you panicked and sold during a market dip, or you stayed in cash for too long waiting for the perfect time to invest. What matters is learning from those moments. Adjust your strategy, focus on your long-term goals, and avoid letting short-term emotions throw you off track. The more you learn, the better you'll get at sticking to your game plan. While many people can handle investing themselves, life gets busy, or if you're not achieving the results you would like, sometimes it helps to have an expert have a second look. If managing your own investments feels like too much, hiring a portfolio manager can be a great solution. That's what I did with part of my portfolio and for many of my clients, and it's been a game changer. The key is finding someone who is unbiased, who's not just selling products for high commissions. Look for someone focused on helping you grow your money. There will be a cost to manage your assets, but that often includes personalized management and strategy and planning towards reaching your goals. Interview several portfolio managers and make sure their approach aligns with your investment philosophy, and ask lots of questions about fees and services. Whether you manage your investments yourself or hire someone, the key is just to get started. At Blueprint Financial, we try to make investing as simple as possible. If you want to learn more, check out the website for our investment resources and services and download our free guide on how to build a $1 million TFSA. And if you enjoyed this or learned anything, please like and subscribe. It's a great way for us to stay connected and for you to keep learning.